If you don't know who Michael Burry is, well, remember this guy? Well, actually, that's not Michael Burry. That's actually the actor Christian Bale. This is Michael Burry. He's the founder of the hedge fund Sion Asset Management. In 2005, he was so confident that the US real estate market would crash that he took out a short position on the housing market worth billions of dollars. The investing world thought he was crazy. At that time, real estate was viewed as an incredibly safe investment, so taking money that his own investors had entrusted him with and using it to bet on the collapse of the housing market was viewed as extremely irresponsible and risky, and his investors were not happy to say the least.
Michael, give me my money back.
But in 2007, 2 years after he first convinced banks like Goldman Sachs to sell him credit default swaps on subprime mortgages, the real estate bubble finally burst. Michael Burry walked away with $100 million in profits for himself and $700 million for his investors. This made such a good story that it was turned into a movie, and Michael Burry became a household name in the investing world. And the reason I'm telling you this now is because Michael Burry is back. Over the past year or two, through a series of mysterious tweets, Michael Burry has been warning us about the vulnerable state of the economy and financial markets. And recently, he made a tweet claiming that we're only really scratching the surface of one of the largest stock market crashes in history. And that begs the question, should we be listening to Michael Burry's market crash warnings? Because on one hand, many people think Burry is a financial genius because he predicted the 2008 housing crash. But on the other hand, many other people think that he's just a one-hit wonder with his predictions, with people like Elon Musk tweeting that Burry is a broken clock, suggesting that Burry is basically only right once every so often, and you can't rely on his predictions. But I think that Elon's tweet might have something to do with the fact that Burry has a massive short position on Tesla. And judging by the way Elon responded when he found out Bill Gates was shorting Tesla, maybe he was just a bit salty that Burry was betting against his company. Anyways, in this video, I'm going to be covering the specific predictions Michael Burry is making about the downfall of the US stock market, what basis he has for his claims, my own thoughts on whether we should be listening to him, and what I'll be doing with my own personal investments going forward. But before we get into it, please drop a like on the video for the algorithm, and also go follow me on Instagram because I just started a new account and would love to connect with you all in there. Last week, Michael Burry tweeted something that got a lot of investors' attention. He said that adjusted for inflation, the S&P 500 is down around 25%, the Nasdaq is down 35%, and Bitcoin is down around 65%. That was multiple compression. Next up, earnings compression. So maybe halfway there. And it's the last line of this tweet, so maybe halfway there, that really got people thinking. What Burry is saying is that he thinks that the stock market has only fallen half of the way that it will ultimately fall. And since the S&P 500 was already down 25% when this was tweeted, that would suggest that he thinks the stock market will fall around 50% from its recent high. And to put that into perspective, if the stock market were to fall by 50%, that would be the fourth worst stock market crash in the history of the United States, preceded by the Great Depression, the recession of 1937, and the Great Recession or the housing crash of 2008. Burry also tweeted saying that he thinks that the stock market will bottom with a Shiller PE of 16, which would be in line with what's happened historically. A Shiller PE is a ratio that investors use to determine if the stock market is fairly valued, by essentially comparing its price to its inflation-adjusted earnings. But we don't need to dive into how to calculate a Shiller PE ratio. What's important is that Burry pointed out that a Shiller PE of 16 would put the S&P 500 at 1,862. And for the S&P 500 to reach this level, it would have to fall by a massive 61% from its recent high. And if that were to happen, that would be the second biggest stock market decline in US history, preceded only by the Great Depression. So in both of these estimates, it looks like Burry is expecting the stock market to fall significantly more than it already has, and bottom out at around a 50 to 60% loss. Burry also tweeted about the way in which the stock market will fall, saying that after 2000, the Nasdaq had 16 bear market rallies greater than 10%, averaging 22.7% before bottoming down 78%. After 1929, the Dow had 10 bear market rallies greater than 10%, averaging 22.8% before bottoming down 89%. What Burry is saying here is that the stock market doesn't just fall swiftly in a consistent downward trend. Historically, stocks decline somewhat, then go back up a little, then fall some more, then go back up a little again, and so on until the stock market eventually bottoms out. He's basically warning us to not get fooled by what's known as dead cat bounces or suckers rallies, which is when the stock market recovers slightly, which makes people think that the market has bottomed out and is starting to recover again, so they invest their money back into the markets, just for stocks to crash further and further again. And as you can see, this is how the stock market has behaved so far during the 2022 bear market that we're in now. Stocks fell in January, just to recover slightly at the start of February before they sank lower. And in late March, stocks actually almost completely recovered to their all-time highs. But since then, the market has continued its downtrend. So Michael Burry is expecting more of this up and come down, but overall downtrend to continue happening in the stock market going forward. Overall, I would say most people at this point are pretty pessimistic about how the stock market is going to perform in the short to medium term, but not many are as pessimistic as Michael Burry. Most people aren't predicting above a 50% decline in stocks. So now let's go over the reasons why Burry thinks that stocks are going to continue crashing. Burry made his opinions on the market known in this tweet, saying, "People always ask me what is going on in the markets. It's simple. Greatest speculative bubble of all time in all things, by 2 orders of magnitude." So this is his overall thesis for why stocks will crash hard. He believes that we're in a massive financial bubble in all things. And this is a thing that some people have nicknamed the everything bubble, which describes how basically every asset class leading up to 2022 has been in a massive bubble. If you think about it, not only have stocks been incredibly overpriced, but real estate, commodities, crypto, used cars, quite literally everything costs way more than it should. And the reason why market bubbles form from time to time is because of human nature. Investors buy an asset like a stock, which causes the stock to go up in price, which then gets more investors excited who also buy the stock. People get greedier and greedier and continue pouring their money into whatever it may be, until finally there are no longer people willing to buy an asset at the extremely high price that it is reached. Then the bubble begins to collapse. And this bubble phenomenon tends to happen in the markets every so often. It happened to tech stocks in the 90s, it happened to real estate in 2007, and now Michael Burry believes it is happening on a massive scale today. In the last 2 years, we've witnessed some pretty crazy things happen when it comes to investing. There was the whole meme stocks episode where stocks like GameStop and AMC were pumped to unimaginable prices. NFTs and crypto became a means to get rich for people that have never invested in their lives. And overall, the stock market reached levels that legendary investors like Warren Buffett would consider to be extremely overvalued. And Michael Burry believes that the massive speculative bubble we're experiencing won't be over until a few things play out. Quoting, "I don't think this is going to be over until everybody swears that they will never own an NFT, they will never own crypto, and they will never own a technology stock. Market crashes finally bottom when peak fear in the market is reached." So what Burry is saying is that that can't occur whilst NFTs are still being traded for hundreds of thousands of dollars. The market is only going to bottom out when people come to terms with their poor investment decisions and think, you know what, I've lost so much money on NFTs, crypto, tech stocks that I don't ever want to own any of those things again. I'm done. Some more specific reasons why Burry thinks the stock market crash we've seen so far is only getting started is because he believes that corporate earnings could suffer in the second half of the year. He tweeted saying that the reason the S&P 500 is down 25% was due to multiple compression. And next up, we have earnings compression, meaning that he predicts that the earnings of companies is going to decrease over the next quarters due to higher costs and slower consumer spending, and that is going to cause the stock market to decline even further. Burry also pointed out that US personal savings have fallen to 2013 levels, the lowest level since 2008, all whilst credit card debt has grown at a record pace, meaning that people are getting into more and more debt and their emergency funds are dwindling, which is likely going to result in most people spending less, which negatively affects economic growth and hurts companies' profits. So these are some of the main reasons Michael Burry is predicting an even larger stock market crash than what we've already experienced. But this begs the question of how much can we actually rely on his predictions? Well, Burry made a tweet highlighting all of the predictions he claims to have gotten correct over the last 2 decades, saying, "Just getting one thing right is hard. 1999 tech bubble, 01 to 05 value revival, 2005 housing bubble, 2009 almond farms, 2020 COVID bottom, 2020 lockdown horrors, 2021 meme stocks, 2021 crypto leverage, 2021 inflation, 2022 not done yet, late 2022? He's saying that he correctly predicted all of these events in the markets. But a quick Google search for what predictions Michael Burry has gotten wrong tells a different story. In 2017, Burry predicted a global financial meltdown and World War III. And of course, that never happened. 4 years after his prediction, the S&P 500 is up nearly 100%. In 2019, Burry said that index funds are the next market bubble. And since then, all broad market index funds are up substantially. And in 2020, Burry called out Tesla for being in a bubble, saying that its stock price is ridiculous. Burry then took out a short position against Tesla, worth hundreds of millions of dollars, and then later abandoned his short position as Tesla's stock price continued to go up and up. And I do agree with Burry that Tesla was and is in a bubble. But here's the thing with Michael Burry. Even when one of his predictions are correct, his timing usually isn't. Burry even said it himself that he's habitually 1 to 2 years too early on most of his predictions. So people who listen to Burry and make financial decisions based on his predictions are likely to get hurt in the markets. For example, if you copied Burry's Tesla short, you would have likely lost a lot of money and possibly got margin called as the price of Tesla continues to skyrocket. So that's why although I find what Michael Burry has to say about the stock market and our economy very interesting, I don't don't base any financial decisions on his opinions. Just because Michael Burry is predicting that the stock market is going to crash 50 or 60%, that doesn't mean that we should wait until the market crashes by 50% before we decide to buy into the stock market, because it might not happen. Imagine how much that would suck if you were to sell all of your investments now, based on Burry's predictions that the market is going to crash even further, thinking you're going to buy in for cheaper when the market crashes by 50%, just for stocks to only crash by, let's say, 40%. So you never end up actually investing your money again, so you miss out on all the gains that you could have made when the stock market recovers. That's why when it comes to my own investing strategy, I'm going to continue doing what's been proven time and time again to be the best way to invest in the stock market, which is dollar cost averaging into an index fund on a consistent basis. That way, if the market does crash further, I get to buy stocks at discounted prices, and if the market recovers from here on out, I'll also make good returns. So by dollar cost averaging, no matter what happens to the stock market going forward, your investments will likely perform well over the long term. But anyways, I know it's been a few weeks since I uploaded. We've been super busy over here with family weddings and all that sort of stuff, but we're going to be more consistent moving forward with videos every week, so make sure you stick around for that and subscribe for plenty more content. Take care, guys. I'll see you in the next one.